Irrational Exuberance by Robert Shiller. This is a book summary. What if I told you that markets aren't just driven by numbers, earnings, and balance sheets, but by emotion? What if I told you that, beneath the glossy headlines of economic growth and bullish market trends, there's something far more primal at play? Greed, fear, hype, the irresistible pull of herd mentality. And what if I told you that the same psychological traps that led to the Great Depression in 1929, the dot-com bubble, the housing crash of 2008, are still happening today? You see, markets don't just move up and down based on logic. They're driven by stories, by what people think will happen next. This isn't a theory. It's a pattern that repeats itself, again and again. That's exactly what Robert Shiller, a Nobel Prize-winning economist, explores in his groundbreaking book, Irrational Exuberance. And let me tell you, this book doesn't just explain bubbles, it predicts them. Part 1, a speech that shook the market. Now, let's rewind to December 5th, 1996. It's a crisp winter evening in Washington, D.C. Inside a grand hall, a room full of financial elites is gathered, sipping on expensive wine and listening to a speech by none other than Alan Greenspan, the powerful chairman of the Federal Reserve. For most of his speech, Greenspan sticks to the usual dry economic analysis: interest rates, inflation targets, employment figures. But then, he pauses, looks up from his notes, and delivers two little words that send shockwaves across global markets. Irrational exuberance. In an instant, markets across the world panic. In Tokyo, the Nikkei index plunges 3.2%. In Hong Kong, the Hang Seng tumbles 2.9%. The DAX in Germany, down 4%. And in the US, the very next morning, the Dow tanks nearly 150 points at the opening bell. All because of two words. But why? Because Greenspan had just called out the elephant in the room, something investors feared but refused to admit. The market wasn't rising because of fundamentals. It was rising because of hype, speculation, and collective delusion. That's the foundation of Shiller's book. Why do financial bubbles form? Why do we ignore warning signs? And why, despite centuries of economic history, do we keep making the same mistakes over and over again? And the most terrifying part, we might be in a bubble right now, and not even realize it. Most economists like to believe that markets are rational, that prices move in response to real economic forces, that investors are logical decision-makers, carefully analyzing data and assessing risk with a cool, calculating mind. But Shiller says, nope. If markets were truly rational, we wouldn't have wild booms and devastating crashes. We wouldn't see bubbles inflate far beyond reason, only to spectacularly burst again and again and again. Shiller's research, which won him the Nobel Prize in economics, reveals a fundamental truth. Markets aren't just about numbers. They're about stories. And the stories we tell ourselves can be dangerously misleading. In Irrational Exuberance, Shiller identifies three big forces that fuel financial bubbles. Structural factors. These are the tangible shifts that shape markets over time. Things like technological breakthroughs, demographic trends, and financial innovations. The rise of the internet, for example, created real opportunities. But new technologies don't just change industries. They also fuel speculation and hype. Cultural factors. This is where media, fads, and collective delusions come into play. The way financial news is reported can amplify optimism, while success stories spread like wildfire, creating a belief that this time is different. Investors start chasing trends, not value. It happened in the 1920s stock boom, in the dot-com bubble, and again in the real estate craze of the 2000s. Psychological factors? Here's where human nature takes over. Shiller explains how fear, greed, and herd mentality turn rational investors into irrational speculators. When people see others making easy money, they feel the FOMO effect, the fear of missing out. Instead of analyzing risks, they jump in head first, convinced that prices will only go up. And when the bubble finally bursts, that same psychology swings violently in the other direction. Fear replaces greed. The market crashes, not just because of bad fundamentals, but because everyone suddenly panics at the same time. A classic example? The dot-com bubble. Let's jump back to the late 1990s. The internet was the future. Tech companies were popping up left and right, promising revolutionary business models. Wall Street went all in on the idea that any company with a .com in its name was destined for infinite growth. A small bookstore? Meh? A small online bookstore? Boom? Let's throw millions at it. Investors weren't buying stocks. They were buying a dream. The idea that the internet was rewriting the laws of business, making profits optional. For a while, it seemed to work. The Nasdaq surged, and young entrepreneurs became overnight millionaires. But then, reality hit. Most of these .com companies weren't actually making money. They were burning through cash at an alarming rate. When investors realized the hype didn't match reality, the bubble imploded. Between 2000 and 2002, the Nasdaq plummeted 78%. Trillions of dollars vanished. Companies collapsed overnight, and thousands of investors, who once believed they were riding an unstoppable wave, were left wrecked. Sounds familiar, right? Because it happened again just a few years later. But Shiller wasn't just watching the stock market. He was paying very close attention to real estate. In the early 2000s, something strange was happening. Home prices were skyrocketing, faster than ever before. Banks were handing out risky loans to almost anyone, and everyone believed that real estate was the safest investment on earth. People genuinely thought home prices could never fall. It made sense at the time, at least on the surface. After all, demand for housing was strong and interest rates were low. But beneath the surface, the same forces that drove the stock market bubbles were at play. The media hyped up housing as the key to building wealth. Psychological FOMO kicked in. People rushed to buy homes before prices went up even more. Banks encouraged speculation, handing out loans with zero income verification. Then, in 2006, the market cracked. Home prices started to stall. Then they started to dip. And once people realized the bubble was bursting, panic set in. Millions of people lost their homes. The stock market collapsed. The global financial system nearly imploded. It was one of the worst financial disasters in modern history. And yet, people were shocked. How could no one have seen it coming? Well, someone did. Shiller had been warning about the housing bubble for years. He even created the Case-Shiller Home Price Index, which tracked home prices in a way no one had before. His data showed that home values were detached from reality, inflated by speculation and cheap credit. Few listened, until it was too late. And that's Shiller's ultimate lesson. Markets don't crash because of bad fundamentals. They crash because of bad psychology. And the scariest part? We could be in a bubble right now and not even realize it. Now that we've seen how bubbles form, how they burst, and how they devastate economies, the big question is, how do we avoid falling into the next one? Because make no mistake, there will be another bubble. It might be in stocks, real estate, cryptocurrencies, or even AI-driven tech. But one thing is certain, the cycle of irrational exuberance will play out again. Why? Because human psychology hasn't changed. We still get swept up in the excitement of rising markets. We still tell ourselves this time is different. And we still believe the illusion of easy money until it all comes crashing down. So how can we protect ourselves? Understand that markets are emotional. Forget the idea that investors are perfectly rational. They're not. Fear and greed drive markets more than spreadsheets ever will. If you see a market soaring not because of strong fundamentals, but because everyone is getting rich, be careful. Be skeptical of new eras and can't lose investments. Shiller warns us about the new era mindset, the belief that some new technology, policy, or innovation has permanently changed the rules. We saw it in the dot-com boom. We saw it in the housing bubble. And we're seeing it again in today's markets. Ask yourself, is this real growth or is it hype? Look for signs of speculation and herd mentality. Bubbles thrive on groupthink. The more people pile in, the more prices rise, and the more prices rise, the more people pile in. It's a self-reinforcing loop until one day it isn't. Watch for markets where people are buying just because others are buying. That's a red flag. Remember, just because prices are rising doesn't mean they're right. This is one of Shiller's most powerful lessons. Markets can stay irrational longer than you expect. But eventually, reality catches up. If valuations seem too good to be true, if earnings don't justify stock prices, or if people start taking on insane amounts of debt just to keep up, it's time to step back. The bottom line? Financial bubbles are not rare. They're not accidents. They are a predictable part of human nature. Markets will always experience irrational exuberance. The trick isn't to avoid investing altogether. It's to know when to step back before the bubble bursts. Because the biggest threat to our financial future isn't a crash or inflation or recessions. It's us. If you found this video helpful, hit that like button and subscribe for more insights into the financial world. And tell me in the comments, do you think we're in a bubble right now? If so, where? Stocks? Real estate? AI? See you next time.